You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means we are back once again with another episode of the Advisor's Option, the program for you out there, the busy financial advisor, asset manager, fund manager. Maybe you're thinking about dipping your toes into those options waters on behalf of your clients and your fund. Maybe you've already done so. Maybe you've encountered some turbulent waters out there. Either way, we've got you covered here on the Advisor's Option. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting The Options Insider Radio Network, just coming off the heels of another great pro Q&A out there. So for anyone out there who's intrigued by the Options Insider Pro, make sure you check it out. We're already up to pro Q&A number 5. Doesn't seem like it's been that long, but yet it has been, with so many great characters. Check them all out. If you're on the pro side, you can get access to the podcast too. So all the episodes you missed, you can go back and check those out on demand anytime as well. You know where to go for all that stuff. theoptionsinsider.com/pro is the place to go. And speaking of pro Q&As, the guy who ably and bravely ventured into that breach for the first time on our pro Q&A number 1, pleased to say, joining us back again today on the Advisor's Option, none other than Mr. Matt Amberson, the founder over there at ORATS, a.k.a. Options Research and Technology Services. Mr. Matt, welcome back to the Advisor's Option. And can you believe we're already up to number 5 of the pro Q&As, which you kicked off, sir?
I went into a cold sweat, Mark. That was a high stress job doing number one and just getting pelted by your great listeners with great questions.
Well, you set a high bar. Everyone's got to live up to it now, so you should pat yourself on the back there. So now everyone who comes in, they're sweating, saying, "Can I live up possibly to the Oracle of New Hampshire out there?" So well done on that. The folks are loving it. In fact, I think we have some questions here at the end of this and maybe dovetailing off of that appearance, but we'll get to that in a little bit. First, let's also welcome on our guest today, good old Mr. Uncle Mike TOSAW from St. Charles Wealth Management, a.k.a. one of the few advisors out there who actually uses options in his practice every day. Mr. Uncle Mike, welcome back to the Advisor's Options, sir. It has been too long.
It has. Always a pleasure to be here to talk to my buddies and people that do the same things that I do, and there's not many of us.
Not many indeed. You may be a little flummoxed. We've added some new segments since your last appearance, so you'll try to keep up as we head right on into the P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, everybody, welcome to the P&L statement. You know the drill by now. Ever since the pandemic kicked off, it seemed like we always spent some time at the top of the show breaking down what the hell happened since our last show, because it was always something crazy and unprecedented and just sometimes head-scratching and worthy of discussion. So we thought, why not encapsulate all of that in its own segment, hence the P&L statement. And Matt, a lot's been going on since our last show here. We've seen a little bit of turbulence out there in the broad market, some rallies, some new all-time highs. Oh, let's sell off a little bit. We've seen vol coming in pretty much nonstop since our last show, with the exception of one spike or so in a week and change ago. So a lot to unpack out there. Well, let's start with that, Matt. So what are your thoughts? What's been lighting up your tape out there in the broad markets and indeed the volatility space since our last episode, sir?
Well, I love to start with how Robinhood has changed the skew and see if it's still there, and it is still there.
So the Robinhood effect still in effect is what you're saying?
It's still in effect. We have those very small calls. As a matter of fact, we were looking for a client today at the Costco long call spread, and it was looking really good on our scanner. And I looked in there, and what was happening was the normal call that we're buying looked okay, but the one that we're selling out a few deltas, maybe a 2 or 3 delta, was extremely high volatility. So that's we've got this kind of what we call a curvature derivative, cortosis, call it what you want, but there's still a curve up at those very small options, and it's a lot of the we surmise that it's a lot of these individual investors trying to participate in this market that just keeps going up by buying small calls and sitting back and waiting for them to move. And they have worked that skew is staying up. It's not pronounced at all in the ETFs, but in the at ORATS we could type in SPY_C and get all the component weighted readings, and one of the readings is what is the 5 delta trading at these various days to expiration. So we look at 30 days, 90 days, and yeah, it's still quite pronounced. So that's going up, even though and just today we saw the vol just coming up a little bit, which is strange because the market's not doing much. But we watch that vol very closely. If it starts kicking up for no reason, sometimes there is a reason. So it just seems like there should be more going on. We got an earnings season coming up. We have, a fair amount going on in the macro world out there. And so we're starting to see just a little, yeah, you're right. The vol has come down since we've last talked, but it's starting to kick up just a little bit. We've been back testing some UVXY and some VXX put spreads, just some things to get short. So that has worked real well. We got out of them, and now we're looking to, vols popped just a little bit here. We're looking to get back into some of those, hopefully not prematurely, but the vol is up a little bit, and there's some more opportunities now, Mark.
Yeah, it's one of those weird days where the markets are kind of struggling to find their footing, and the vol, you're right, kind of ticking up a little bit, which makes you kind of stroke your chin and say, perhaps there are other shoes waiting to drop, other things lurking out there. Let's go on out now to the quiet hinterlands of St. Charles, where there is no volatility because everything is always tranquil and calm. Mr. Uncle Mike, I know you're our diehard kind of go-to permabull out there. Not so much a bullish day, unless you're looking at the NASDAQ up a little bit today. The rest of the indices kind of mixed to down on the day, but vol kind of ticking up a little bit. What are your thoughts on everything that's been lighting up your tape, not just today, but over the course of the last month, really since our last episode here on the Advisor's Option? Like I said, we've seen a mostly drift up in the markets and a mostly drift down in the broad volatility environment, sir.
Yeah, I would agree with that in terms of what your comment on drifting, for sure. In that we look at it, we had one little scare, so to speak, about 10 days ago, just looking at my chart here on the 18th, when we had a drop in the marketplace. But other than that, it's just kind of been just a very boring drift higher. And for a while, it seemed like we were just stuck to the 4,200 level on the SPX. But it seems like we're finally breaking away from the 4,200 magnet, if you will, in the last few days. And so we have that. There's not been, in terms of news, we've had the news in relation to the spending bill that President Biden's talking about. Late last week, it looked like we're going to spend lots of money. Things were going to be good for the marketplace. And then he said, no, I don't know if I want to sign that. I want more. And then it looked like it wasn't going to happen. Now it looks like it should happen. So that kind of seems like the dance that we're getting from the politicians in Washington at this point in time. The other thing that's happening, we're really not getting a lot of follow through in the energy area. So in other words, energy in and of itself, we're at similar levels, at least with XLE. The energy ETF, we're at similar levels now as to where we were back in March. So we're kind of just still puttering around in the energy area. And also, financials have been so insanely hot since the beginning of the year that they're kind of leveling off a little bit over the course of the last couple months as well. So, I mean, we had a little bit more of a rally going into early June. Then we were pulling back to levels with which we were a couple months ago as well. Tech, that's an area with which that's just been red hot lately, ever since probably mid-March. So we do have that. So from what I'm seeing on everything, in terms of the market going up and kind of drifting up rather slowly, we're getting exciting action, but different exciting action in different ways amongst sectors. So it looks like we're kind of rotating a little bit in terms of where we are in the marketplace. And then last but not least, my beloved 10-year note has been kind of sticking to that 1.5 mark for the yield on it. So we still have that. And, Bitcoin's getting hammered. And that's pretty much what I've been seeing the last month.
Well, you kind of kicked off the whole Bitcoin hammering. You and Musk combined. You did the old 1-2, Uncle Mike, when you came out in your infamous rant and said you weren't in on the whole crypto. I think it was the very next session that it started selling off. So I think you could take some of the blame / some of the honor for turning around crypto, Mr. Uncle Mike.
Well, me and my good friend Elon Musk, who has no clue who I am, I guess we work together.
Yes, a combo of Musk and Mike. As we head right on into our next segment, it is time. Tail end of the season, listeners. It's time to sink our teeth in one last time before the wheel turns once again. It is time for the earnings volatility rundown.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the Earnings Volatility Report.
All right, everybody, welcome to the Earnings Volatility Report, the segment where we break down all the data, all the numbers that Matt and his team over there at ORATS have been crunching for us since our last episode. They're so nice. They crunch all these numbers just for you folks, the listeners of the show and the readers of the website out there. And it's been shall we say, an intriguing season, Matt. I know you went out on a limb early, a couple episodes ago on this show, and you made that prediction that I made a few cycles before that, and I got horribly burned. So I kind of have pulled back from that one. And you went bravely out onto that limb at the beginning of this season and said this was it. This was the season that we were going to see the worm turning. We're going to see vol start to outperform compared to every other cycle since the pandemic, where it seems like volatility in a lot of these single names, from an earnings perspective at least, has been almost moot. No matter what happened, the vol would just come in after they announced. So, Mr. Matt, I'm curious for you. I'm sure our listeners are curious. What are your thoughts now on that prognostication as we near the end of the cycle, sir?
Yeah, as we've talked about and been scratching our head for the last year now, there's just been so much more and other things going on than people looking closely at earnings and why earnings are changing and why and what's moving those stocks. And the option market continues to bid up earnings in the face of not much happening. But July has had that inkling of an earnings, a little bit more excitement, Mark. So I'm going to go out on a limb again. I'm already out here, so what's a little bit farther out on the limb to go to say that we're going to see some interesting fireworks. Let's just say I'm already seeing some of our calendars blow up a bit, meaning they're expecting some earnings-related volatility. The implieds of the month directly preceding the earnings date is much lower than the the first earnings month. So we're starting to see that Apple, Facebook, and a few others. Our scanner's been pretty hot identifying those, and so we've been looking at those. So, whereas the last earnings season, we still have that report up, only returning a loss of 26% on your straddles, which is very bad. Usually it's right around, almost right around a break even, whereas usually the win ratio is 40%. It was down at 28%. So it's pretty horrific last earnings. And even with the implied earnings moves coming down, from just trickling down a little bit, we're still seeing some tough times for buyers. So it just seems to me it's still the Robinhood effect. Like, the Robinhooders aren't looking at earnings that closely and not moving stocks based on earnings. So I'm thinking that's trickling into the earnings, and also there's a lot of the other stuff that's going on. COVID related, macro related, has really the micro earnings moves. We've been seeing that lacking in the last year, but it's got to come back sometimes. The people out there setting these markets, they're worried. So let's see if this next earnings, sometimes July has been quite a month for earnings, and I think it might be this time too, Mark.
Well, we keep making that call. It's got to happen sooner or later, right, Matt? One of these days, one of us has to be right. It has to turn around. The worm has to turn. Hey, we did get Nike right at the tail end of this cycle, kind of blowing the cover off the ball to extend the sports metaphor out there. So maybe that's a sign. If we can read too much into that one report, perhaps that's a sign of things to come. As you mentioned, Matt, overall, the season, not exactly a home run out here for vol buyers, averaging out. So looking at your latest report, and again, you can check these out for yourselves, all for you folks, for free listeners. TheOptionsInsider.com is the place to go. Click on that options news and articles tab. You get all of Matt's team's latest reports. You can always head over to orats.com. Check out the latest and greatest over there as well. Averaging out to a 74% this season, listeners. So if you bought a basket of all the earnings vol out there throughout the entire season, which would be a pricey basket, you would have returned about 74 cents on the dollar. So obviously not exactly a bonanza for vol buyers. The worst week was week 2, 51%. You got cut pretty much in half. The best week was week 5, 96%. So you almost broke even. That's things are crazy when people get excited about almost breaking even out there in the world of all things volatility and everything else. But now it is time for us to keep rolling, listeners. You folks love your education out there in the advisor space, and what better time to revisit a classic, what we have called in the past the Holy Grail for financial advisors. What are we talking about? Let's find out in Options 101.
It's time to learn how to use options to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, welcome to Options 101, the portion of the show where we break down some basic options concept or technique or strategy and explain how you can utilize it in your clients' portfolios. And this is a return of a good one. It's extremely appropriate given the current market environment that we find ourselves in. Remember, recently on the show, listeners, we dovetailed one of the most important positions out there for advisors, which is the covered call. We got into all the nuances therein. So we thought we would extrapolate upon that and take it to the next step, combine it with the other most popular position out there for a lot of advisors, other most popular and most common use case really for options, which is to protect assets, which are things people are considering right now, given the fact that we're at or near all-time highs in most of the major indices out there. Volatility has also come in, maybe a time when you're starting to think about protecting those positions. And now we get to a position that is pretty much a combination of the two things advisors like to do most when it comes to options, aka the covered call and the protective put. What if we took them both and we just combined them together like Voltron? We formed something new and cool from the pieces. And that's what we're talking about today. The collar, aka what we've called in the past, the Holy Grail position for financial advisors. I'll just break it down for you here really quickly with a quick example, then I'll get everyone's thoughts on this. I know they have a lot to share, a lot of thoughts on the collars, its use case, and some pros and cons. We'll get into all of that. But if you're confused, if you're new to the show, I know a lot of you are, so welcome. And then B, this is one we've done into this in the past. I encourage you to check out our archives for some longer discussions about the collar. We've also touched on them on shows like Options Bootcamp and Options Playbook Radio. So if you want more on the collar, check out those as well. Let's go into the archive, search for collar. You'll find a lot of content until your heart's content. But a collar, what are we talking about? Let's go out to everyone's favorite name. XYZ is trading right around $100. And you're long 1,000 shares, let's say, your client is long 1,000 shares. Let's say around the 70 handle. So you got some profits you're sitting on. Not unlike what we're seeing in the market right now, where some folks are sitting at some profits and they're kind of maybe a little bit concerned about the future, but they also don't want to get the heck out of Dodge and sell the position either. And that's where the collar tends to come into play out here. So you think there probably is a little bit more upside to the future. You don't want to give up that upside, at least not all of it. But also, you also don't want to just sit there and ride it right back down again. So this is where the collar can come into play. So let's look at our example. Maybe your client and you're comfortable. You had a nice run. If it runs another $10, you don't mind, in this scenario, maybe selling that stock at 110. So you turn around and you sell the 1 month covered call. We just talked about these recently on the program. If you want a deeper dive into covered calls, go back and check out that episode from just a few episodes ago. Very, very intricate discussion on covered calls out there. So in this case, you sell the 110 covered call out there for 1 month. In our example, you get a nice round $1 to do so. So you collected $1, aka the 100 multiplier. So you got $1,000 to do it there on these. Remember, you have, of course, 1,000 shares of the underlying, so you have to do 10. So 10 times 100, aka that's where we're getting that $1,000. Now, you have that $1,000 you collected, but now you say, I have some money in my pocket. I'm also a little bit concerned about the downside. Maybe let me go out and look at some protection. And in our example, you can go out to, let's say, the 85 put. Got to go a little bit farther out because the puts are typically more expensive in the equities from a vol perspective. So you got to the 85 push track. That's also trading for around $1. And guess what? You can come in now and buy those as well. Buy 10 of those, spend that $1,000 you just collected, and now you've done what is known as the collar, which means effectively you collared your stock position. If it moves above 110 in our example, you're out. And if it drops below 85 in our example, you'll be stopped out there. And that's why we call it the collar. A lot to unpack here. We'll start with Uncle Mike as our guest, sir. I know you do a lot of short put spreads and a lot of other things, but I know the collar comes into your rotation as well on behalf of your clients, maybe even particularly now, given where we are out there in the marketplace. What are your thoughts on collars? When do you like to use them? And then also, how do you typically like to set them up? A lot to unpack there, sir.
For sure. Typically, what I like to do with a collar is kind of a synthetic collar. I'll do a traditional collar, and I actually have a story about how one really benefited quite a bit due to COVID here in a second. But I like to do a synthetic. So if you ever put in a collar on any type of a risk reward graph on all the various tools out there that exist for that, a collar, when you see it's like that traditional S shape on the risk reward, it's identical to that of just a vertical call spread. And so with that, what I typically do with a collar from that standpoint is that I will take a vertical call spread or take a small amount of money and do something with call options, and then take the larger amount of money and use it with something boring like bonds or cash value life insurance, annuities, or not a lot with annuities, but it does fit the bill occasionally depending on the client. And I'll get the similar effect to the collar. And I like it because of the fact that a lot of times I'll run to clients with smaller amounts of money in IRAs and larger amounts of money outside of IRAs. So that's kind of what I'll refer to as my cross IRA simulated index, simulated collar, whatever way you want to call it. So that's kind of a way that I use it. And the reason I like it is primarily because of the fact that you can really take advantage of the tax benefits of an IRA while using options. And I would say that's the main way, which, well, quite frankly, I've built my entire career. But there are instances where I'll use a traditional collar like what you described. And I like it when I like locking in a gain to where I literally just put one on recently for a client 2 days ago. And I also like it when a client is just so scared of market exposure, I can say, okay, well, how about this? Why don't we just put X amount of dollars in the market? I think you really need some exposure, but what if I can guarantee that it's mathematically impossible for you to lose more than this amount? And we talk for a while in terms of how we want to set up the collar. And I'll use it if it's someone who I refer to as an options outsider. And I actually did start using these terms before the network, Mark. So I have options insiders, which are 98% of my clients, and options outsiders to where people who just don't use the option product that much or are not very familiar with it. But I would say
my lawyers will be contacting you after the show, sir. I'm just letting you know.
Got it. So anyway, but with that, just kind of something I'll refer to in talking to other advisors. I don't use it for any financial gain by any means. But what I'll do with it is for clients that are just really concerned with it, I'll put on a 1-year collar. I'll just say over the course of the year, you're either going to make 10% or you're going to lose 10%, or somewhere in between, but we don't know where. And I'm typically not very active with that, in that I'll wait till closer to expiration to where I can get out of both options for a real small price, or I'll let it get called away. And unless I have something to where it's just a total no-brainer type of situation, then I'm not going to be very active whenever I'm using a traditional collar. Now, here's a time to where I was pretty active with it. I had a client, and one of the collars that we had was XLE. And he was an options outsider, very much an options outsider. And so he was very concerned with downside risk. And so when we went into COVID, I think we got into XLE in probably like the mid 60s, something like that, when we actually first put this on. Please don't quote me on the numbers. I'm not trying to do this, just kind of give you an idea of this. But during COVID, XLE actually got down to, and I'm just digging up a chart here, we actually got down to the low 20s. So we went from the mid 60s to the low 20s. So for every $6,500, we have pretty much a $4,500 put option sitting there. And we only have like $2,000 worth of stock left. And so at that point in time, I called the client and I said, you know what? Am I guaranteeing that XLE is going to go much lower or can't go much lower? No, I'm not going to give you that guarantee. But we've literally, initially, we've had a $6,000 allocation towards this position. Now we only have probably a third of what we originally had on. So we've essentially taken away 2/3 of the risk because this just went down so darn fast. And so we talked for a while. I'm like, how about we just make this, instead of a collared position, let's just turn this XLE into a buy and hold position at this point in time. And let's take profit on these put options. And so what we did is we bought just a basket full of stocks with the profits from the puts. It was very diversified, a bunch of different stocks. We talked about it. This wasn't just a 2-minute phone call. This was several hours of talking and doing a bunch of things with it. But what that did, that collar offered us the opportunity to diversify, change the position because the allocation, the exposure to XLE became so much less. And we bought a bunch of stocks. And as everyone knows, after COVID, the market went way up. And so we benefited quite a bit from that. So with that, XLE is trading not very high again, but we've benefited from all those stocks that we have going up. So recently, I put the collar back onto XLE. We're going to do a nice, long, boring collar, so that way the client has his protection on. He has his risk management in place. And it's beautiful because of the fact that if for some reason we have something crazy like that happen again, like COVID, or, well, of course, who can forget the day that oil was trading in negative numbers? That was kind of crazy. If we have another crazy year like that, I don't care because the put option's in place. And if XLE does go way down again with this specific client, then my plan is to take profit on the put when it's along those lines. And we'd probably do something along the lines of what we did before. So those are some of the ways with which I like to use collars. I think that they're important. They're a vital tool to have as a financial advisor, just because of what you can do with it. Another story I just thought of, I had a client a few years back. They owned Apple at an extremely low cost basis, but they didn't want to sell Apple because they lived in California and they wanted to make sure that they didn't take the tax hit, and they still liked Apple. But Apple was several $1 million, and it was a vast majority of their net worth. So what I did with them is we set up a collar, and we set up with a strategy in such a way to where I said, okay, I can get you roughly 70% of the upside, and when Apple goes down, we'll have roughly 30% of the downside. And it worked. We did a really good job with that, but eventually they left, and their rationale was we want more than 70% of the upside. And so I'm like, well, I can't quite keep up with that. So we departed the best of friends, and hopefully for their sake, they've held on to all their Apple, and hopefully they're still collaring it in some way, shape, or form. So I think the collar is a phenomenal tool to use as a financial advisor. And I would say that with the fact that bond yields are so low right now, stocks are at all-time highs right now, I think the collar, or a concept thereof, is just a vital tool to have in the financial advisory space.
AKA the Holy Grail, some might say, for financial advisors. Mr. Matt, you must get questions about this all the time. I'm sure a lot of the advisors and asset managers who are coming to you, even the retail coming to you over there at ORATS, are probably very intrigued by this position. So you've probably done 1 or 2 back tests on the collar over there at ORATS. What do you have to share with our audience? What are your thoughts on it? First off, the utility, do you like them, or maybe not a fan? And then B, if you are going to use a collar, what is your optimal approach, sir?
Yeah, so it's a very good tool. You have to break it down into its parts is my first bit of advice. So you're long a put, and we know that being long puts are very expensive, and you're short a call. And the problems with being short calls is you don't get to participate as much on the upside. You've owned these stocks, you own the market, and when it starts running, you want to participate. So we like to look at it. We like to look at it in its component pieces and backtest in its component pieces. Show clients what to expect on each side. And generally what we find is, and I've talked about it on this program at length, is the put, a longer term, way out of the money put, maybe overdo it, meaning if you have 100 shares, maybe you buy 1.5 or 2 puts to every 100 shares. If you're buying this, 500-day 5 to 10 delta put, you can generally buy those and have a lot less decay. And it does depend on the volatility levels. When you don't want to buy it when a market's crashing, those puts get bid up a lot. But if it's in a market I'm starting to dip my toe in right now, we're getting about 22 vol for a lot of those puts right now, and so starting to rebuild these really long-term puts. So again, treat those on their own, longer term, more out of the money, and then on the call side, we've done extensive studies to where you really want to pick your place where you're selling these calls. Out of the money. It doesn't matter whether it's earnings related or not, but you have to get a good premium for it, or otherwise it's not worth it. We measure what's called spread yield, which is the option price divided by the stock price. That has to be a certain amount before you even want to be selling those calls. So my advice is to back test it based on your underlying holdings that you have, and only sell those that have enough premium for the calls. And when you're buying, either buy a market-wide put. That's usually a lot cheaper than an individual stock put, if you can handle that type of underlying risk. But if not, I would err towards going longer term, more out of the money, Mark.
Yeah, that seems to be the consensus out there. I've touched on this before on the show. I want to just mention it again. One of the few long-term studies I've really seen about collars across a wide variety of assets came to us courtesy of our friends over there at the OIC. We'll link to it in the show notes. You can find it over there at optionseducation.org. Just search for collars over there. If you just type collaring the Qs, that'll get you there as well. That's how they started this study. They started it just looking at the efficacy of collars in the long term on an equity index like the NASDAQ. And then it kind of spread into looking at collars across a wide variety of asset classes. And they have nearly 5 years worth of data. The study is getting a little bit older now. I would like to see them update it. For example, when they did it, weeklies weren't as much of a thing as they are now. So maybe adjusting it. What they found in all their various iterations, listeners, is kind of along the lines of what Matt was saying. They did better results, and they found better results when they pushed the put out a bit. In their study, they found the optimal period was about 6 months. Again, it's going to change depending on what you're looking at, your frame of reference, everything else. But they found for their usage across a wide variety of assets, they did a 1 month, 5% out of the money covered call. Again, weeklies might make that a little bit of a different story. But at the time, 1 month, 5% out of the money covered call. And they paired that with a 6 month out put. I forgot exactly how far out of the money they went with the put. We'll have to look into that. Obviously, it's going to change a little bit depending on the underlying you're looking at. And they have results across a wide array of asset classes. People usually think, oh, collar, that means, like Uncle Mike was just saying, I'm probably going to underperform if there's a dramatic upside, and maybe I'll outperform a bit to the downside. What they found is that collars are actually far more competitive from a total performance, analysis than you might initially assume. Obviously, from a risk-adjusted perspective, they blow the doors off. But the old saying, you can't eat risk-adjusted return. So even from a cumulative return perspective, they were surprisingly effective. Look at this. In this period, they studied the S&P. It was about 5 years, and the S&P actually sold off in that period nearly 10%. So your collars are going to do pretty well there. The collars made nearly 15% in that environment. Even in some other asset classes that weren't dramatic sell-offs. They looked at a currency ETF out of Canada, and they put a collar on that. The ETF made 9.25% over those 5 years, whereas the collar made nearly 14%. So interesting things like that. There are some periods where it underperformed as well. Looks like in the Australian dollar, they had an FX trade going on, and that rallied nearly 50%. The collar did about half of that, about 26%. So there are some periods, dramatic outperformance to the upside, where you will indeed underperform. But overall, I think one of the interesting takeaways from this was that the collar far more effective from an overall return perspective than you may initially assume. So if you're a little bit leery, you don't want to clip your upside, and that's certainly something you should maybe consider and play around with it a little bit. Maybe head on over there to ORATS and do some back testing of your own on how you like to structure. But definitely check out that study. Still, to my knowledge, to this day, the only really far-reaching study of collars across a wide array of asset classes, not just on your, say, your S&Ps and everything else like that. But I want to go back to something really quickly that I know is important for the audience of this show. And Uncle Mike, you kind of just touched on this. Maybe we'll go to you first. Is in general, for a lot of clients, for advisors, taxes are an issue. And so they come to you and say, hey, like in your example, they want to collar this position, but they don't want to pay the taxes on it. So I'm curious for you, Uncle Mike, when you're setting up a collar with those kind of restrictions in place, does it change the game for you at all? Does it make you maybe move because obviously the covered call portion is the part you're going to get in trouble with there. Do you maybe move that a little bit farther out of the money? Do you maybe more aggressively babysit it when it comes to rolls? How do you make that tweak for clients out there that are a little bit more tax sensitive?
Well, step one, I think you need to see how much IRA money is available. And let's say, for example, I'll just oversimplify it. Someone has $100,000 in a stock with a big capital gain built in, and they have maybe $20,000 in the IRA. First thing I would do in a situation like that would be along the lines of trying to set up some type of a simulated put spread or something along those lines within the IRA. So that way, let's say that the stock does just tank, then you can take all the profit you want in the IRA. And if the stock tanks, you essentially just gave yourself a free IRA contribution because of the fact that you're going to profit that much on the puts within the IRA. Now, what position to set up, when to set up, how to set up, we can talk for hours on that one. But essentially, you can buy puts and sell call spreads within the IRA. And if you have that choice, my opinion is that's the best way to go if that's available. Now, let's say it's not available. Then the first thing that I'll do is I'll tell clients, I'm going to aggressively babysit this collar, as Mark Longo put it. I stole another one from you, Mark. I'm going to use that one for sure.
My lawyers are going to be busy today.
They are. But I'm going to aggressively babysit that. But with that, you do have to be prepared for the fact that these stocks could get assigned at any point, or that you could get exercised at any point. That is out there. I warn them of that risk. Sometimes you can even get called away on an out of the money call. That's the technical term that I use for that. Although I've had it happen to me maybe 3 times in 20 years, but it does exist. It's called stupid exercise. Someone on the other side of the trade is stupid, so they exercise an out of the money option. It can happen, and it does happen, but it is very rare. So I warn them about that. And the other thing that I'll do is I'll say, okay, then perhaps we can sell a call spread. So that way we won't get as much income on the call side of it. But if the stock does run to the high heavens, then you can still have that protection to the upside. And they'll say, well, but then we still get called away? And I'm like, yes, you could. And then at that point, when we really get even deeper into that, once I explain that, and this is what I have done in the past, instead of selling an out of the money call spread, so that way you can protect yourself from the upside, but you're giving up a little bit of income, what I'll actually do is sell a put spread. So that way you're synthetically getting the covered call spread income without any risk of early assignment. So it's kind of an in-depth process that I'll go through when I'm in a situation like that for a client. But those are kind of the things with which I'll look at, because if a client's coming to me with several $1 million and he wants to collar a stock that's worth several $1 million, it's probably, I just summed up probably a 3-hour conversation in 5 minutes, but those are the things with which I'll tell them, and then what we'll go through with it.
There you go. So there's something to consider if you're considering collars on behalf of your clients. I know it's tempting when you go out there to put these on. A lot of people like to go the zero cost route. It certainly looks nice to have that zero outlay on your sheets every month. But, just pay attention to what we were just talking about, what Matt was just talking about. Check out this study. It probably will behoove you to put a little bit of an outlay to this, push that put out a little bit farther, move that call a little bit closer to expiration. It's going to require a little bit more diligence on your part, but it seems like the returns are definitely worth the effort. Again, this is a great position for a lot of advisors out there. It combines the two most common, the two most popular use cases for advisors. When it comes to options, if you're not familiar with collars, you definitely should check them out. As we keep on rolling into our next segment, it is time to get the buzz.
Busy financial advisors and asset managers don't have time to follow the latest developments from the world of options, so we do it for you. It's time to get the buzz.
All right, everybody, welcome to the buzz. I know we got some good questions, listeners lining up as well, and make sure we get you guys on. So we'll take a quick segue, quick sojourn through the buzz today. But then the big story everyone's focusing on these days from the world of options, and certainly coming into this year and now heading into summer, it still is the big narrative out there, is whether the party can continue. And by party, I mean, of course, the options volume explosion that we've seen hitting the tape pretty much month in, month out since the pandemic first kicked off in earnest back towards the early portion of 2020. Coming into this year, the first quarter was the busiest quarter in the history of options. Pretty much every month was a new record out of the gate out there. So it seemed like the year was roaring in. Of course, we had the GameStop madness and everything else really fueling a lot of that. And now the numbers are available for May soon. Soon we'll have the numbers for June, so we'll know the answer for June. Summertime, not usually a rip-roaring time for options, and yet May was yet another strong month. Not a new record for the highest, most active month ever, but still, it was the highest volume May on record. So total volume for May, 723, almost 724 million contracts. It's up 32.7% from just a year ago in May of 2020. And 2020, as we all know, was no slouch when it came to options volume. More impressively, though, everyone wonders if the year can do more paper. Is it even possible to do more paper than they did in 2020, which was a ridiculous amount of paper already there? And so far, year to date, the numbers are looking pretty impressive. Year to date ADV, so your average daily volume through May, is 39.3 million contracts a day hitting the tape, listener. That's up nearly 42% from this time last year. So at least so far, through the first half of the year or so, the answer appears to be a resounding yes to can that party not just continue, but grow in leaps and bounds. Now, Matt, I know one of the interesting questions, you talked about the Robinhood effect at the top of the show. One of the interesting questions is, can retail keep playing? Can they keep coming to the party en masse the way they have been when they were locked down at home during the pandemic and they had nothing to do but trade? I know you monitor a lot of this data as well. So what are your thoughts, A, on the numbers come out of OCC, and B, what are you kind of seeing anecdotally behind the scenes over there at OCC? Does it jive with this, or you think maybe things are going to quiet down a little bit?
Yeah, so what we see, we get an interesting cross-section coming to ORAS because we offer, we've been around so long, since 2001, that we have dividends, we have earnings, we have APIs, we have scanners, we have real-time, we have delayed, we have our own web-based tools. So we get a piece of a lot of the market, and we're seeing more of the API hits. So I'm what's happening, I think, is a lot of quants are figuring out some strategies and trading a lot more. That's the way I'm seeing a lot of this volume increasing so much. It's just whereas when we were on the floor, we wouldn't bat our eye for a 1 or 2 cent profit. These people are taking half-cent profits and trading, all the time. So you're able to do a lot if you have a good bot. So I think it's a lot of, I think a lot of this volume is a lot of bot volume, but there are a lot more people coming in. But I did hear anecdotal stories like, we're bored, so we're going to trade some options. We can't really go anywhere, so I want to sign up and get some information. So it's kind of funny how you get those those retail people that are just looking for the gamification of it. And you certainly can see these products like Gatsby, obviously Robinhood, but there's quite a bit more. You talked with Trader before. They have just more and more platforms coming to their front ends that are getting people on, that make trading seemingly a lot easier and more fun. Of course, we hope that they would start to look at theoretical values more. We do quite a bit when I trade or when we develop products. We are looking at things like, our forecast values. Compare that to the market. We have a smooth value. Make sure you're not paying over on these wide markets. Make sure you're not paying way over the midpoint or our theoretical value. We have distributions based on historical that we create theoretical value. So before you trade on ORATs, where the edge is. And so I'm afraid that some of these gamification front ends are bringing people in, but that won't last long. I mean, it's been very bullish, and these people tend to be long. So we're getting those people in, but when that turns and the liquidity really dries up. I mean, we saw liquidity and markets really widen out in the COVID crash. When that happens, it's going to be pretty bloody for these guys. So, can it continue? I think it can, but it can't continue forever. These people have to get a little bit more sophisticated with their tools, and hopefully the platforms could help these people, have the longevity needed by a lot of research, of course, back testing, and not only back testing but good scanning features. Mark,
I like that. Measuring the API hits, seeing what's going on the back end. Let's see what's going on with you folks now. You wait patiently for your questions every month. Let's get to them. A little bit of the old office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to the office hours. Let's just dive right into it. We got a lot of people lining up, including this one for you, Matt. This came on the heels. We talked about at the top of the show, your appearance there on our first pro Q&A. Looks like it spawned this question here from Daniel Twyman. He says, this next question to follow up on Matt's Q&A. He said Matt was talking about, quote, overlaying strategies, and you also mentioned Chris Cole. He said he looked him up, and he sees they do some high-level trades to protect portfolios during major downside while staying diversified and seeking quality stocks that are non-correlated and keep your portfolio going up even if it is slow and steady. He says he talked about selling an in-the-money put and buying an out-of-the-money put, which is like selling an out-of-the-money call and buying an in-the-money call. I wanted to get more clarity on that trade and how we can overlay that strategy with other trades such as put credit spreads, butterflies, etc., when uncertain about market direction and just seeking to hedge and lock in profits during those periods of uncertainty. Let me go really quickly. He has an addendum to his question. This is an epic one. While we're on the topic of overlaying strategies, a favorite trade I use often is doing calendar spreads in SPX, usually about 30 days out, when the new weekly expirations come out on Fridays, and I strive to build a zero delta position, usually starting with at the money and going in 25-point intervals, about whatever the IV is for that weekly series. I typically close out of positions that fall out of the one standard deviation and try to open new calendar spreads, but that doesn't always work. Wanted to know if you knew of any strategies or positions that could be added with different expiration dates and strikes that could complement a trade like this when markets are turbulent and there are struggles, I should say, to keep a zero delta portfolio. Sorry for the long, drawn-out questions, but I'm a student of the game and love learning about derivatives and ways to use them under all market conditions. Well, Dan, Usually I cut you off at one, but you're one of our pro members. And also, that was a good question. We like to let you go a little bit when you have multiple points. So, Matt, this one's for you. I'll let you go at it first. A lot to unpack here. Overlays, selling in the money puts, as well as calendars. Take it in any order you want, sir.
Well, first of all, let's just take a minute. That is an awesome question. And kudos to you, Mark, and all the people that come on to educate these people, because there's a lot of learning that Dan's done. And so this is great. So, let's talk about that in the money, out of the money put. He's correct. I mean, I have that strategy. It tests really well. It's just being long. SPX, it's a good way to do it. It's essentially a poor man's covered call in that, when you're selling that in the money put, you're getting a lot of premium up front. And that is akin, and doing that spread, the flip side of it is a long, in the money call spread. So you're doing, you could look at it as a call spread or a put spread, but you're essentially selling the upper strike vols and strikes and buying the lower strikes. So that like I said, it's akin to a poor man's cover call. So it's a good way to get long. And what it also does is it gives you some income, and it also protects you on the downside, since you're not just long an underlying like SPY. You're doing it's almost a collar position actually. So I like that position. We back test that. That's definitely one that when we test for people, we put that one in the mix. And then but you're long, and we want to have, I like to always have that protection on the downside. So I like to look at these out of the money puts, of course. I keep harping on that. So you have some of those. And then what you'll find in the back test is that that type of position does well in almost all markets, except for 2018. What happened in 2018, especially the December portion, is the market just kind of trickled down or slid down without an appreciative vol increase. So what happens when you're long those out of the money puts and you get a vol increase, the market doesn't even need to go near those puts, and you make a lot of money. Well, in 2018, you didn't. So since then we've added what's done really well is that type of calendar spread. So, Dan's really on it. Like, the calendar works well in 18. So, especially if you have some type of you can visualize a payoff picture that looks like a peak, and then it going down to someone's hair that goes down on their shoulders. So and it looks like a butterfly in a sense, but you're justifying that down, maybe 5%, 10%. So if the market drifts down for that calendar, you're going to do well. So basically what Dan's saying here is you have, a typical long strategy that's like a poor man's covered call, which is the in the money, selling the in the money put, buying the out of the money put. And then you also have, I at least have way out of the money puts that does well during these crashes. And then you have something that does well in 2018, and those other times when the market just kind of drifts down, which is the calendar. So, he sounds like he's hedging. He sounds like he's got an overall long strategy and something that could profit, what Chris Cole calls, of Artemis, by the way, calls crisis alpha. So when things really hit the fan, he's got some way out of the money puts. We also overlay some selling of put spreads on top of that, but that's just complicating things. But anyway, great question, and hopefully that helped, Mark.
Yes, that's great stuff. We could unpack it more, but I want to make sure we'll go a little long today. Why not? We love all of our listeners out. You guys wait so patiently, including interesting questions. In fact, we did a great pro Q&A last week with John Cherry from Northern Trust, and I believe this question came in for that. I thought this would be an interesting one to also discuss here for this audience of the advisor's option. This came from another one of our members, Tony Papadopoulos. I just like saying it that way. I don't know why. If I'm butchering your name horribly, if you prefer to be called Anthony, let me know. It just sounds fun to say Tony. All right. He says, Mark, thank you for offering a great product to your pro members. Oh, well, you're welcome, Tony. He says, how can we implement some high net worth / institutional strategies in retail accounts of less than $1 million? Does the quote long-term selling of Buffett puts also work for retail investors? Is there a way to minimize the margin on these long-term short puts? Furthermore, are they sold in the money or deeply out of the money? Looking forward to your insights. So kind of dovetailing off what we were just talking about with selling the in the money puts. Now he wants to do the quote unquote Buffett puts that everybody loves. Mr. Uncle Mike, I'm sure you've had a client or two ask you about this. They want to use the big boy strategies, but their accounts maybe not that big yet. I'm sure a lot of the advisors in our audience, their clients are probably fall into a similar boat. So what are your thoughts on the quote unquote Buffett puts? Are there ways to minimize the margin hit on those? And do you prefer to do them in the money or deeply out of the money? 3 questions, sir.
All right. In terms of can you use them? Yeah, absolutely. The only time that you can't use them like the big boys would, so to speak, is that let's say that you wanted to sell puts on like a Google or an Amazon or something like that, where the price of the underlying is very high and you just want to sell some puts on it. Difficult to do on those stocks, but there's plenty of other stocks out there with which this can definitely work for clients with less than $1 million. I do it all the time. And I would say with that, how can you do it to minimize margin requirements? Well, you could, if you really wanted to, let's say you're selling an out of the money put. If you wanted to buy another put at maybe 50% of the price, like some hunk of garbage for a penny or something like that, you could do that if you wanted to leverage. I don't do that. I don't think it's wise to do that unless you are putting the other money into like treasury bonds or something like that. I don't feel it makes sense to do levered premium selling. I like, if you're going to do levered premium selling, then understand that it's leverage, have your stops in place and that type of thing. But trying to do a Buffett style premium sale leverage, I'm not a fan of personally. I think that there's other ways with which to leverage yourself in the option space besides that. So to cover the 3 questions, can you do it under $1 million? Absolutely. How would you do it? I like to sell something that is probably, if you want to go the Buffett route, you can go maybe 10% out of the money, but you can go 6 months to a year out. And that way you can say to your client, well, look, we just got paid for buying this stock on a 10% dip. And if the stock is volatile enough to where that can be of a good position for you, then great. If not, then there's plenty of stocks out there that are. So to answer the listener's question, I think that's kind of the way with which I look at it. And once again, I'd really recommend not leveraging yourself with Buffett style puts.
Mr. Matt, anything to add here for Tony, who wants to know all about Buffett puts, sir?
Yeah, I would echo a little bit of what Mike says. But there are put spreads too that you could do on these names when they get so high priced. But what we're seeing as well lately is that these puts don't have the skew in them. So if you know anything about skew, find an option. The individual names, the skew is not there. The SPY, now the skew is coming back quite a bit. But you could do a put spread, but then you end up being a buyer of skew. So if you're going to do a put spread, you want to get something a little bit flatter. So that's all I would add to that, Mark.
All right. We went beyond our allotted time. We probably could go longer, but I can't hold these guys here forever. Good questions, everybody. Everyone always asks about the margin side. To the end of the day, the only way to really clip your margins, what Matt said, you buy something, do the put spread against something like that, then you're buying skew, so you have to be comfortable with that. But if you want to skate on the margin, you have to have something else to offset it. And so That's usually where the put spread comes into play. But great questions, everybody. Before we go, let's go back around the horn. Let's start with you, Mr. Mike. If folks are intrigued, they actually want to talk to a real live advisor who actually uses options day in, day out, where should they go? What should they do?
A couple places. And I'm in this for I believe in the progress of the business. So if you're an advisor, if you want to ask me some things that I do and ways we can talk shop, and if there's any way I can help another advisor, I'm happy to do that free of charge, because quite frankly, we need more advisors that do options. Feel free to contact me. Or if you're a client that wants to invest with me, by all means, you can call me too. But you can follow me on Twitter at Mike TOSAW, TOSAW, or visit my website, stcharleswealth.com. You can get my information on how to contact me there. And this is a product and a business I am very passionate about. I've built my whole life around it. So feel free to reach out to me.
stcharleswealth.com. Give him a follow on the old Twitters as well, at Mike TOSAW. And while you're over there on Twitter, he's easy to find. He's just Option Rats, all one word. Pretty memorable title. Mr. Matt, if they go to Option Rats or perhaps to orats.com, what will they find, sir?
Well, I just want to say for Mike, that's a great, I echo that. I mean, and I'm sure you do too, Mark. We're in it for the love. We've been in it for so many years. And, we're long-term players in this, and we trade and we have our clients trade. We want success across the board. So if you come over to ORATS, whereas Mike will give you some hand-holding and talk you through some things. ORATS has the tools, the back testers, we're working hard on our scanners right now, auto traders. Once you do get a scan that you like, we're setting it up so it could alert you when certain things happen. So there's a ton of stuff going on. I mentioned the APIs for people that do it themselves. So there's a ton going on at orats.com. Mark, I'm going to announce it here. And then the next couple of weeks is a new ORATS website. So we'll have to let you know when that launches.
Didn't you just upgrade your website not too long ago? You're on the cutting edge, the bleeding edge over there, sir.
Yeah, it seems like, but it's already 4 years.
Really? Oh, okay. Yeah. I guess, time flies. In the web terms, that's like 100 years. So
yeah.
I don't wish website redesigns on anyone. I know how fun they could be. Something always happens to gum things up. But stay tuned for that. Check out the new and improved coming soon. Orats.com. ORATS is the place to go. You know where to go, listeners, for that collar study I was talking about earlier. A lot of great research and education for you, the advisor out there. It's optionseducation.org. It's the homepage of our friends over there at the OIC, a.k.a. the Options Industry Council. Check them out. A lot of great content there as well. On behalf of everybody over there in the OIC and Matt, everybody over there at ORATS and Uncle Mike and indeed myself, I want to thank all of you out there for downloading, streaming, and subscribing, for listening live, for sending in all those questions. Keep them coming. We love to hear from all of you. We'll be back again tomorrow. If you want more questions, sounds like Brian's all fired up to do a live huddle for the OPR. So got some questions to answer there tomorrow as well. Also be doing another live boot camp with Dan. So Education Wednesday in full effect tomorrow. Getting your double dose of live, sounds like. Tomorrow, Thursday, of course, we've got TWIFO and episode 2 of the Option Block. Friday, of course, Volatility Views. And for you pro folks out there, Options Oddities. Then we kick off, hard to believe, we're kicking off another month already into July, which means there'll be another episode of The Advisor's Option.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.